Good day, folks. The canary in the coal mine is finally speaking to me, and it's saying, Kyle, this is the time to start paying attention to those stocks that are interest rate sensitive, because I feel like we are about to see a massive recovery and return in many of these stocks. And I'm looking at Canada as the canary in the coal mine, but I'm looking to go to the US because anything that happens in Canada when it trails in the US, you usually see a 2 or 3 times the amount of multiple return in those investments. Now, Canada, obviously cut the rates yet again today. We saw a 0.25% cut, which means we've seen a total cut of 0.5%. We're now down to 4.5%. And what does this mean? Well, it just generally means that if you're looking to get a mortgage, if you're using debt, if you're doing anything with this, you're starting to see your monthly payments go down unless you have a fixed rate, right? A lot of people are seeing their mortgages renew in the next 1 to 2 years. They're going to be very grateful that they keep cutting these rates. And so we're going to expand on this, take a look at my portfolio, see what my investment theses are, where I'm going to look to put new money. If it's a conversation you'd appreciate, consider hitting that like button and subscribe if you're on a path to financial independence to damn well one day retire early. Now, Canada has been trading in the 2% inflation rate area for quite some time. So there's a good, it was a good expectation to presume they were going to cut rates because we've been down there. We've hit targets since the beginning of the year. So they're probably going to continue to cut those rates. In the US, we have not got any rate cuts yet, and that's because we've been trading in the 3% range. But it's likely in the coming months we'll get down to the 2%, and come the September Fed meeting, Jerome Powell will be more inclined to cut those rates. Now, something that I wasn't expecting is as they cut rates, the Canadian dollar has been quite a bit volatile, and it didn't seem to like the interest rate cuts that much. And this is why I don't want to make my entire investment thesis in Canada, because the Canadian dollar has been absolutely devastated, especially even last year. If you look at the peak of just from December 27th, 2023, the Canadian dollar has dropped 4% in comparable to the US. So you would have made an extra 4% return from the peak if you just put your money in US dollars. Forget US investments. So this is why I don't like overexposing myself to the Canadian economy. And you might think to yourself, well, Kyle, the TSX is flat today. There's nothing going on, even though they're cutting interest rates. And what I'm going to tell you right now is that you need to zoom in a little more, because holy crap. Take a look at this, because the big companies, like our biggest companies, are banks, and the banks aren't performing as well today. But when you look at real estate, utilities, when you look at energy, telecom, everything is starting to show signs of life again, because these companies are heavily infrastructure oriented, which means they come with a lot of debt. And when there's a lot of debt and interest rates are where they are, it's going to hinder the stock performance. And if you've been holding REITs and utilities in these stocks, you've been wondering to yourself, when is it ever going to end? When is the bleeding ever going to stop? And I think we're finally getting to that pivotal turning point. So what does this mean for my portfolio? How am I looking at taking advantage of it? Well, firstly, my portfolio has been relatively boring. Outside of making really great profits on Tesla, tech is dropping pretty dramatically, which is also an interest rate sensitive sector. You could look at buying some of the dips there, but we'll discuss that more in future videos. However, I just want to focus on what my portfolio is lacking and why I want to continue to diversify it, because as it stands right now, I'm 55% the S&P, 29%, 30% almost in SCHD, which honestly, I think a lot of stocks in SCHD are interest rate sensitive. But for the most part, I don't think you're going to see huge movements if they cut interest rates here anytime soon. But there are sectors that will immediately see huge movements from interest rate cuts, right? And that is also not what is in VDY. VDY, I would have thought would have seen a little bit more performance today, but it's not, because it's really exposed to the banks and stocks that aren't seeing the same fluctuations from the interest rate cuts. So I want better exposure. I want to make outsized returns. And right now, I think I can get them from incredibly boring stocks. And those boring stocks sit in the sectors I have the least amount of exposure to right now. If we combine all of my ETFs together, we take a look at the exposure it gives me. Many of you know I'm 20% right now in information technology, 18% roughly financials, 11% give or take in healthcare. But what I'm lacking really is I have little exposure to utilities, little exposure to real estate, and a little bit of exposure to the communication services. These are the sectors that are going to have the most outsized returns as interest rates come down. So I've been taking a look, and I like using this as a really great example. VRE, the Canadian real estate ETF, is up 3% just in the last 5 days. This is like the most green we've seen pretty much in the entire year. It's up 12% from the lows, and we haven't even seen the effects of the interest rate cuts come into play on these these earnings yet. And this is how much people price that stuff into the future, right? We presume if interest rates are going to stay high for a while, we might as well price that into the future and just let these stocks get absolutely cratered. But as the interest rates come down, they're going to start exponentially pricing that in to future earnings. And even though we've seen these initial jumps, there's going to be a lot more to come. I can promise you that, because they're not going to leave interest rates at over 4% forever. It's just not going to happen, right? So I don't like VRE personally. And not for any particular reason other than I already own a property in Toronto. And as interest rates come down, realistically, the demand in these high demand areas should continue to go up over long periods of time, meaning that this big piece of real estate, or this condo that I own, not a big piece of real estate, but this condo I own in Toronto, realistically should go up in value as interest rates come down over a long period of time, because it allows more people to get in the market and it makes these properties more affordable, right? And we're starting to see that effect here on these ETFs that I won't buy because of the exposure I have to Canadian real estate already. So it's just personal preference. I just don't want all my money exposed to the Canadian real estate market. However, I do recognize that this is one of the most interest rate sensitive areas that is going to see a massive, massive recovery soon. I mean, you take a look at the BMO Equal Weight Utility Index. This one's up 1% just today alone. Similar to that REIT ETF, you zoom out on the long here and it's been nothing but getting cratered. And as of recently, we're starting to see some gains, like double-digit gains in a very short period of time. This is where you make real money. I mean, you can get crazy high dividend yields off these ETFs, and you're going to get huge recovery in a capital gain perspective. But you had to be so patient, right? I just haven't bought these because there's been no reason. I told you I'd rather wait to see when the recovery starts and then buy the rally back, and that's what I'm looking at here. Now I'm looking at things like Fortis. I've been trying to avoid the individual stock exposure, but I'm recognizing that it might be the easiest way to play it because I do not like a lot of these ETFs. Like the BMO Equal Weight ETF here, ZUT. It's just not one of my favorites because, I mean, you take a look at the yield is great, but the annual management fee is just insane. Like, I don't want to pay. I told you, usually my max paying for a management fee is about 0.3%. You get higher than that, and I'm kind of like turned off because that is a huge percentage of your return, right? It wipes out 0.5. It takes you down to a 4% yield here. And same with VRE. I mean, VRE charges, and it's like, what's the current expense ratio on this? Yeah, 0.35. It's just on the bleeding edge of how much I'd want to pay. But still, if we take a look, Fortis is great. I think Hydro One, even though it's trading toward all-time highs here, still a great company paying a great yield that will benefit from lower interest rates. I'm starting to look at TELUS finally. These telecom giants, I think, are finally starting to look super appealing here. Not as much as Bell. I do like TELUS more particularly. And again, this is on the Canadian side of the border. I'm looking at divvying my new investment capital between maybe just a couple of these Canadian utility stocks just to kind of continue to build that percentage out in my sector weighting. But I'm also looking at buying VNQ. Now, VNQ has started to rally back a little bit. Nothing substantial this year. It's mostly just flat. It did come out of the gutter with the rest of the market. It is up 14%. However, this hasn't seen the full benefit of any interest rate cuts yet. So if we see a material rate cut start to happen in the States, just like it is in Canada, something tells me we'll start seeing the same inflections, right? Well, all of a sudden, this ETF will just jump up maybe like a couple percentage points. It usually does 2 to 3 times whatever the Canadian stocks do. So if VRE, for example, jumped up just today alone, let's just take a look here, in my presumption 1%, I wouldn't be surprised if these US counterparts jump up 2 or 3%. And that's only, they're the only things in my view, primarily because I don't want any more Canadian real estate exposure. I just can't do it. It would be foolish from a sector weighting standpoint for me. So I'm really looking at perhaps picking up some VNQ here, which is something that I hold in my parents' retirement fund. And this one falls very much in line with everything that I like. I mean, we're talking about, if we can find here, first and foremost, the fees are extremely low at 0.13%. I don't know what the current yield on this one is. I don't think it's much more than 4%. I don't think it's huge. Yeah, it's 4.25%. So I could lock in an over 4% yield and hopefully get some incredible recovery. This kind of falls in line too with like Realty Income. There's a lot of stocks that I would take a look at if I wanted to play the individual recovery. But honestly, I think I'd rather get sector exposure to the whole sector. It's a little less risky. It's something that I could potentially hold for a much longer period of time. And yeah, I'm just very excited here because I think this is the very start of the turnaround story. Now, these obviously are just opinions of my own, but I'll pass the question off to you. I'd love to know what you think in that comment section.